Welcome to the Explainer. Okay, let's dive right in because a really chilling warning signal has just flashed across the stock market and we absolutely need to understand what it means.
So, first things first, what exactly is this signal? It's called the Hindenburg Omen. You can think of it like a market health checklist. When a very specific set of technical conditions are all met, we're talking a high number of stocks hitting new yearly highs and new yearly lows at the same time, the omen gets triggered. It's basically designed to warn of a sudden, unexpected market downturn, which is why it has that name, to evoke a catastrophe out of nowhere.
And this isn't just some quirky name, it has a pretty startling track record. According to one analyst, out of the last 30 times this signal has popped up, the S&P 500 fell in 83% of those cases, within just 2 months. I mean, that's a statistic that gives this warning some serious weight.
So why is this signal flashing right now? What's actually happening under the surface of the market to set off such a notorious alarm? Let's break down the conditions that have brought us here.
This indicator isn't new. It has a history of showing up right before major market disasters. It was developed back in the 90s, and it famously flashed right before the dot-com bust and again before the 2008 financial crisis. Today's alert? It's been triggered by things like weak market breadth, which basically means the rally is being carried by just a handful of huge stocks, while most other stocks are actually struggling.
All this anxiety in the stock market, well, it's creating ripple effects. And to see how this tension is playing out in other high-risk assets, we've got to turn to the crypto market. It's facing its own massive multi-billion-dollar test right now.
The sheer scale of what's happening here is just staggering. We are looking at one of the biggest options expiries on record, with over 123,000 Bitcoin options contracts about to expire, and their total value, a massive $12 billion. Events like this can inject a crazy amount of volatility into the market.
And it's not just Bitcoin. Ethereum is also seeing a huge expiration. But what's really strange is the investor sentiment. The put/call ratio, which is basically a measure of bearish bets versus bullish ones, is nearly identical for both Bitcoin and Ethereum. This kind of perfect alignment is super rare, and it suggests traders have a very unified expectation of where prices are headed. So while a lot of traders are placing their bets, the institutional money, the big money, seems to be heading for the exits. U.S. crypto ETFs saw nearly $500 million pulled out in a single day. And this wasn't some small move. Major players like BlackRock were involved, which signals a pretty significant risk-off moment from the big guys.
But here's where the story gets really complicated. Just as all this macroeconomic fear seems to be taking over, key crypto-related companies are stepping up and reporting surprisingly strong earnings. They're completely defying the gloomy outlook.
The contrast here is just wild. Coinbase posted a massive $432 million net profit, and then you have MicroStrategy, the biggest corporate holder of Bitcoin, reporting a net profit of $2.8 billion. Both of these results absolutely crushed what analysts were expecting, and the market loved it. MicroStrategy's stock jumped nearly 6% after hours.
And if you dig into Coinbase's numbers, you see a really telling story. Yeah, revenue from trading fees is still a huge part of their business, but the steady growth in their other areas is what's really impressive. Revenue from subscriptions and services grew significantly. This kind of diversification shows their business is maturing, and they're building a much more resilient foundation.
So how on earth do we make sense of all this? You've got a terrifying market crash omen on one hand, and then these blockbuster corporate earnings on the other. This brings us to the massive tug-of-war that's happening in the bigger economic picture. We have several powerful and conflicting forces all pulling at the same time. The Federal Reserve is still sounding hawkish, hinting that rate hikes could come back. We're starting to see cracks appear in the credit market. The stock market's rally is dangerously narrow, and as we're about to see, key assets like gold and Bitcoin are suddenly moving in opposite directions.
This split between assets shows you the confusion perfectly. Gold is acting like a classic safe haven, rallying even with a strong US dollar. Meanwhile, Bitcoin, which so many people call digital gold, is doing the exact opposite. It's selling off, pressured by that same strong dollar. This divergence is a key signal that investors are getting nervous and running to traditional safety.
And it's not just technical indicators flashing red. Major financial institutions are also sounding the alarm. This report from Nomura specifically points to how fragile regional banks are, warning that their financial reserves are shrinking. These banks, they say, could be the first domino to fall in a wider credit crisis.
So all this leaves us with a market that is stretched to its absolute limit, just pulled in opposite directions by these powerful contradictory signals. The key takeaway here is that this tension between strong company fundamentals on one side and these weak macroeconomic indicators on the other, it just can't last forever. Something has to give.
For more news and in-depth analysis, check out our Telegram through the link in the first comment. That's your Daily Edge. See you next time.